Hey there, and welcome. Aaron Zugala from Coldwell Banker and Newman Real Estate, alongside with Brett Milton from Centre Wellington Mortgages. Wanted to set up a little podcast, maybe some do's and don'ts in the real estate and lending world. And Brett so kindly has given us some of his time. Great guy to work with. Anybody that I've sent over to him has been over the moon. So that's all that I ask, is that people are taken care of. And I know that when I send the email or the phone call, I don't have to worry about it. So it's really good. So I'll let kind of Brett introduce himself and see what happens.
Yeah, I appreciate it. And likewise, obviously on my end, I have the pleasure of working with a lot of realtors, and definitely, when it comes to clientele that Aaron sends over, they're very well educated. They're very driven in terms of knowing what they want to do, and I always say great clients make great files. So we're, it's a pleasure to work with.
I can remember that
with
one.
him and his clients as well. Yeah, it's a good mantra, right? It's true too. It's a true sentiment there. So, so I work with Mortgage Intelligence. I'm a mortgage agent. I'm based out of Laura, Ontario. Most of my business is kind of triggered towards Centre Wellington, Guelph, Kitchener, Cambridge, Waterloo, but license covers all of Ontario. So that's it's kind of me in a nutshell here. And, Aaron and I did send a few things out through social media, just touching on a few questions that maybe some people had lingering. And we got three really good ones in response. So those are the three that I think we're going to focus on here today, because they really relate to both of our expertise and kind of what we can bring to the table to help you become mortgage ready and find that next property, whether it's owner occupied, whether it's an investment property, and whether it's owner occupied and an investment property.
Right.
And that's kind of what ties into the first question that someone asked us, and that was, how does qualifying for a mortgage with a legal basement apartment differ than if I'm just buying it to essentially live in it? And it's a great question, and it's one that actually a lot of people, I think, need a little bit more awareness of, because I think there's a little bit of psychological timidness when it comes to the topic of investment properties, and a lot of people think they have to be a millionaire, and by no means do you have to. I mean, I had my first investment property at 27, and I grew up in a working class family, and then by no means was I or am I a millionaire. It's something.
Not yet, Brett. Not yet. Yeah.
It's something that it's really just understanding the strategic side of it and preparing yourself as much as you can, and kind of to delve into that. If you're looking at, let's look at a bungalow, for example, with a legal basement apartment in it. So if you're looking at basically a standard duplex in that sense, if you're looking to purchase that bungalow just in and of itself as an owner-occupied residence, it's really going to be predicated on your debts and your personal income level. So those two things, considering we're in a B20 and stress test environment, that can make qualifying a little bit difficult. So sometimes if you're purchasing as an owner-occupied plus a rental property, we can do some rental add-backs to help you qualify. So you may be curious about how that add-back system works. So basically, the way that it would happen is we would get an appraisal on the property that would confirm the market rent valuation for what that basement apartment would essentially be. We then take that income, plug it into the mortgage application, and it effectively, most lenders do an offset of about a 50% add back. So let's say you're getting $1,200 a month based on the market rent appraisal. You get $600 a month that we get to add back to your income to help you qualify for this overall mortgage. So for a lot of people who are maybe looking to get into a more desirable neighborhood but are struggling to qualify on their own, this is a great add back system that you're going to want to look at. Now, certain lenders do their offsets and rental add backs a little bit differently. Stock standard is about 50%, like I said, that we can add back, but it's a great program that a lot of people should definitely take a look at.
And I think that's one question that over the past number of years that I've had chats with clients, both brand new and also past clients. The concept of having that mortgage buffer, whether it's if they want to get into let's say a larger home, for instance, but not really qualifying.
For sure.
We can always look at that aspect of, is there something out there currently that's already been legalized?
Yep.
Or the option to possibly purchase and then put that legal one or two in that would give you that kind of mortgage buffer.
Absolutely.
I think, and bungalows, as Brett mentioned, I mean, they're just they're very easy to work with, and
popular scenario
yeah,
too, right?
It's very it's good. So, and I think once you kind of explain that once I've explained it to the client, it does make a lot of sense, because if the lender is allowing that 50% of, let's say, up to $1,200, so $600 is basically an addition to your income. I mean, it allows you to bump up to that next step that you might not have even thought of or entertained. It's easily attainable. You just have to ask the right questions and get out and see the properties for sure. So
for sure. And one thing I would kind of add to that is the one nicety as well is that if you're looking to purchase a property as owner occupied and rental, it really creates a lot of flexibility in your down payment options, because if you're purchasing a property outright as a rental property, automatically you're going to need 20% down, whereas if you're owner occupying it plus adding a rental, we can look at an insured mortgage, and insurers are absolutely okay with rental add-backs and whatnot. So creates a lot of flexibility in how we structure the deal as well.
And then 5% down as well?
Yeah, correct, is an option. Yeah, so if they want to do an insured mortgage, yeah, they can absolutely
Sure.
have less than 20%, 5% being the minimum.
Yeah.
We can look at setting it up that way too if you don't want to divvy up as much capital towards that initial investment. So yeah, definitely something that we can take a good look at. So actually, you have a bungalow right now as well.
Yeah, we just listed one on Monday on Joseph Street, which would lend itself ideally. It's a little over 1,100 square feet. Currently, there's not a legal basement apartment in there, but with the separate entrance, you'd have to kind of blow out one of the windows. Just have the city kind of come through on the codes and the do's and don'ts. But it definitely would allow someone to, get into that property with a little bit of elbow grease and have that mortgage buffer. It's easily attainable for sure.
Awesome.
Yeah.
Awesome. Moving on to number 2 here, and this is one that actually Aaron and I have been talking about a lot lately because a lot of clients are curious about it, and whether asking their realtor or mortgage professional, it's something that we have a firm grasp on, and that's credit score. So, question here is, what's the number one thing holding back most people's credit score today? And in my experience in the files that I tend to work on, I find that the number one thing that's holding credit scores back relates to high utilization. So, to explain what that means, most Canadians in general are pretty familiar with the importance of making their credit payments on time and paying their debts on time. And Canadians, generally speaking, are pretty good at this. If you look at statistics on consumer behavior, this tends to be one component that people are very aware of. Utilization is a different story, and I find a lot of people really, when they originally come to me, they don't understand this, and oftentimes it's a little bit of a strategic tweak, and then all of a sudden their credit score tends to climb pretty substantially. So utilization just basically means how much you're utilizing of your existing limit on. Let's use a credit card for example. Say you got a credit card of a very small limit of $5,000, and you're regularly carrying $4,000 in month-to-month balance. Well, that 80% utilization is something that's going to very much hurt your credit score, assuming the rest of your credit lines kind of act in a similar way.
Right.
Lenders really like to see the magic number is about 30%. If you're utilizing 30% or lower of your limit, lenders love that because it really promotes the idea that you're a very conscientious borrower. You're not somebody who typically gets in trouble with their debts, and obviously having a strong repayment history is relevant too. But if you've got something there that shows that you consistently keep your utilization low, lenders love to see it because it builds a lot of confidence in who you are as a borrower. Right. They love to see that. So that would be the number one I see, despite the fact that it's the number 2 in terms of relevancy to what impacts a score. It's the one that most people overlook, and it's substantial. Right. We've talked about how easy it is to often revert that score, although it takes some time. It's really important when we look at keeping somebody on the prime side of lending, wanting to be with those big banks, the mono lines, where the greatest level of flexibility and the most attractive interest rates are. Credit score is very, very important when it comes to qualifying for those mortgages. And last question here that we received was, what's the largest mistake most people make when they are renewing their mortgage? And this is actually really relevant to both what Aaron and I do collectively, because one of the scenarios we were talking about is, let's say somebody is waiting for their renewal date to pull a refinance because they want to utilize equity in their current home to purchase an investment property. Well, not only does this naturally take a fair amount of planning, but it also requires a substantial amount of time just to set the mortgages up appropriately. So I find the biggest issue that I find when it comes to renewal dates, whether it's for that purpose or even just a stock standard switch and wanting to explore other rates out there, is timeline. Clients often have the expectation that they can reach out 1 week before their renewal, a couple days before the renewal, and think everything's going to be okay. The mortgage world is fairly complex, and lenders require so much documentation to verify yourself as a borrower, get everything satisfied and then ready for closing on the legal side or through, say, First Canadian Title, that the timeline required is very important. So, I encourage most people to reach out 120 days prior to the renewal date. That, number one, allows us to ample time to plan strategically about what your next move might be, even if it's just rolling in consumer debt, or like I said, maybe purchasing a new property and looking to incur a minimal prepayment penalty. Timing is really key, and 120 days is a great time to do that. The other side is most lenders that I work with, they'll offer you, if we can secure an approval within we'll get a 120-day rate hold on, particularly fixed rate mortgages. So if you're looking to go fixed and we lock in that approval, we get 120 days from that date where even if rates skyrocket, your rate is secure. So it gives you that sense of protection moving forward. But if interest rates come down, we simply reapply for the new rate. So it's a really good proactive way to kind of approach this. So depending on...
And would you say it's better, you have better negotiating skills in it? Obviously, if you start...
Absolutely.
Okay, so it's better to... Okay.
Yes.
Just be proactive.
It gives us better time to understand the file.
Right.
If it needs a creative solution that needs to be reworked, that maybe can't, come up in a couple hours, and we need a couple days to digest it just to engage. Most definitely, that timeline is fantastic. And if, you give your mortgage professional and realtor that amount of time to kind of work with your file so that they can collaborate to structure a plan that works for you as well, you're going to be very happy. And that's kind of the magic number that we tend to work with.
Perfect.
So,
well, I think, I want to thank Brett for driving all the way to Guelph, spending some time with us here. No, he does tons of work in Guelph too. And I want to thank you for your time, and we'll definitely do this again. Any other questions that you might have, please make a comment down below. Would love to maybe gather some more info on another podcast, but we'll keep doing this. Hopefully, you'll definitely see us again regardless. And
Yeah, keep sending those questions in, guys. We really appreciate it. It's nice to know kind of what's on the mind of consumers out there. And again, no names attached to it or anything. If you have any question at all, don't hesitate to reach out. We want you to be comfortable. And the only stupid question is the one you don't ask. So guys, ask us anything, because we realize there are a lot of moving parts to this, and we want you to be as prepared as possible, because like we both know, the real estate industry moves pretty quick.
Definitely.
And we want you to be in the best position possible to take advantage of it for whatever it is you're looking to do.
All right.
Take care, guys.
Thank you.